let's start with some theory on this component of Unit 4. So when we look at a definition of unearned revenue, it represents the funds we receive in advance for goods or services that we've yet to actually supply. And this will be in the form of a cash deposit. So we've received money in advance for work that we need to provide in the future. So this inflow of funds, the deposit, only half satisfies the definition of revenue because there's two criteria for revenue. First of all, we're going to have an increase in assets, and we've ticked that box because those funds, that deposit, will go into our bank account, so our assets are up. But because we have not earned the revenue yet, we haven't done the work, we haven't provided the service or supplied the goods, we haven't actually earned any profit. So we're not ticking off the increase in owner's equity criteria. But we do satisfy the definition for a liability when we receive that deposit because it's creating an obligation to transfer an economic resource within the next 12 months because as a result of the deposit, we've got to either complete that service or provide or supply that inventory. So therefore, by actually holding off the recording of the revenue until we actually earn it, which will be when we supply the inventory, we are satisfying the accrual basis assumption, which requires us to recognise revenue when it's earned, not when it's received. So when we do receive that deposit for inventory that we're going to supply in the future or a service that we're going to provide, we create an unearned revenue account. So let's have a look at a practical example here. So we have a business here that's placed an order for some stand-up desks. We have a quote on the price. We've got the cost price here. And then the next day on 2nd of April, we've actually received a deposit. So first things first, the question, part A is actually asking us to record the deposit. So therefore, this $2,000 will be recorded as unearned revenue because we've received the money, but we haven't supplied the goods. So therefore, we're going to go up to our general journal here on the 2nd of April. On the right here, our cash at bank has increased. So that's a debit. That's it going up by 2K. And we're going to create a liability account called unearned sales revenue for 2K. I'm not going to bother with narrations here. So then we get to a theory question, always good to practice these. Part B here is asking us to classify the unearned revenue and to justify that classification. So as I talked about before at the start of the vid, it would be classified as a liability, a current liability. 1 mark for that, 1 mark for generically defining what we mean by liability, the obligation to transfer an economic benefit as a result of a past transaction, and that transaction was the $2,000 deposit we received. And then a clear link to the scenario emphasising the fact that we do need to supply some desks on the agreed delivery date. So 1 mark for identifying where it fits in our accounting reports in terms of the classification, 1 mark for a generic explanation of what we mean by liability, and 1 mark for a clear link to the scenario. Now let's move on to the meaty part of the question. We're up to part C. We've got the 16th of April here. We've delivered the desks. We've issued the business with an invoice. And so now we've actually earned all of that revenue for the 50 desks at $150 each. So we've got a whole bunch of entries that we need to deal with here. Now, there's a few alternative ways of treating this transaction. I'm going to split the actual deposit part of it, which we dealt with in part A, to the remainder, the remaining funds that are owing. So what we need to deal with here is the fact that we created this liability account up here with a $2,000 entry to that, and that liability account is void because we've actually supplied the desks. So therefore, we're going to need to reduce that liability with a debit entry. So let's start with that on the 16th of April, a debit to unearned sales revenue because we have extinguished that liability. And what's our credit? Well, our credit entry is actually the sales revenue that's been earned. Because again, according to the accrual basis assumption, we recognise revenue when it's earned. And that's on the 16th of April when the goods have been supplied to our customer. Now we've got a bit of maths to deal with. So again, 50 desks, sale price is 150 each, 50 times 150, that equals 7.5K. That is the revenue we've earned. We've already recorded $2,000 based on that deposit. So therefore, we're not going to double record that, but we do need to acknowledge the fact that we have earned another 5.5K in revenue. So this, because there's an invoice, this is now a credit sale. So therefore, we need to do a debit entry to our accounts receivable. Let's not forget about the GST effect of this. So the GST is recognised at the point of delivery. So we've got 15 desks times $15 each. So 10, whoops. So therefore we're going to have 50 times 15, $750 worth of GST. So let's just do a credit entry there, 750. Now, in terms of the sales revenue, as I said before, this is where we need to be really careful here. We've earned 7.5K in total. We've already recorded that 2K, so therefore we have another 5.5K remaining. So in terms of what the accounts receivable owes the business, we need to add these two credit entries. So therefore we come up with a total of 6250. Now, often students will neglect the final part of this, and that is the cost price effect. So we do need to acknowledge the fact that we had 50 desks with a cost price of 60 each. So therefore, if we multiply those together, we will get a $3,000 debit and a $3,000 credit to your standard accounts in terms of the cost price effect, so cost of sales, and your inventory is decreasing. And that's it.